Good morning. It's October 29, Friday, 5:46 a.m. This is episode 22. Time to be cautious. Good morning to you, Wawi.
Morning, Mark.
And good morning to our listeners. I hope everyone had a great week so far. How's your week, Kuya Wawi?
It's good. Just
All right.
mostly slowing down.
Slowing down. All right. As we head on to the weekend, Halloween weekend, by the way. um,
Yes.
this is your host, Mark Yu.
And Wawi Santos.
And welcome to the Mark Yu and Wawi Show. Disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. Um, we are available in YouTube, Spotify, and Google Podcasts. On our previous episode, 21st episode, we discussed the stock market sentiments and industry performance, financial conditions, consumer sentiment, real estate conditions here in the US, and the bullish sentiments from Wall Street analysts not seen since 2018. So if you guys want to listen or head back, listen and to that episode, feel free to listen to it after this episode that we have. So for this week's episode, we are celebrating yet again another achievement by Elon Musk, richest ever person in the world at almost 300 billion net worth. This
Wow.
morning, I just saw a highlight. Elon Musk tweeting that the Congress plans on taxing the rich that would not help him get people to Mars, which is interesting. You know, this guy has definitely a different kind of vision for the future. So this is an article from CNBC. 13 years ago, Elon Musk made a bold prediction about the cost of electric cars, and he was right. So when everybody else was, doubting the plans of driving electric cars, basically, correct me if I'm wrong, Huawei, that the Tesla model is basically designed where it's a car chassis built on top of a big phone battery, like a car phone battery. So as of
Yeah,
this
it
time, you still
is.
have to charge it, plug it, and charge it, and wait for a few hours or a few minutes, half an hour maybe, to full charge.
Yes. So the infrastructure for those charging stations are part of that ecosystem
Mhm.
that he envisioned.
Right.
So
So
it's across the nation now.
mhm. They're popping up every here and there, especially in the West Coast, I believe, all over California, heading to Vegas.
Yes.
So this is the net worth or Bloomberg Billionaire Index that can be seen on the website. So number one, of course, Elon Musk. Oh, look at this. He surpassed 300 billion. Last night before I slept, I thought it was like a 297. But this morning, it surpassed $300 billion. Right now, Elon Musk is 302 billion in net worth. From January 1st of this year to today, he gained 132 billion in net worth.
It
Whew.
will go up maybe another 2 billion today.
Oh my, wow. And it's never ending. Look at how he surpassed Jeff Bezos. At one point during the summer, Jeff Bezos was the richest man for a few weeks, but
Mhm.
he's now 103 billion richer.
Yeah,
Like a Buffett richer.
the
Warren
options
Buffett
in
105.
the options interest is so strong on 1100. I think
Uh-huh.
it's
On Tesla stock. Uh-huh.
on Tesla stock right now. It's hovering at around 1077, and I think everyone's betting it to be at 1100.
Right. Kathy was just thinking about it could reach 3,000. But look at here. Elon Musk is now one Warren Buffett richer than Jeff Bezos. But
Oh no.
Buffett is 105. No disrespect to all the value investors out there, including me. But yeah, Elon Musk just gained one Warren Buffett in wealth at this point in
Mhm.
time, followed by Bernard Arnold. You know, I think he is the one for Bernard Arnold, Zara,
Is
if I'm not mistaken, the clothing company Zara. Yep.
oh
No, Bernard Arnold Foundation Louis Vuitton. No, Bernard Arnold at net worth 168 billion is France's richest person, chairman of Louis Vuitton. Sorry about that. Um, So Tesla stock price for the past week, as you may have already know, for those who have Tesla in their portfolio like Huawei, has surged 20% in the past 5 days alone. It surged 38% in the past month alone, and it has surged 48% since the start of the year. And if you're a truly believer of Tesla, which you've invested back in 2010 when it first listed, back when it was just hovering at $3 a share, you would have gained 28,000% in your investment. So, reminiscing some press releases by Tesla back in the day, back in January 28, 2010, when it filed its S1 registration for IPO. And when it opened, it was around $3 a share. Now it's hovering 1,000. Back in 2009, Tesla reported that it just has delivered its 700 Roadster in Germany.
Well, the top three, billionaires right now, one is selling bags, the other is selling cars, and the other is selling everything else.
Everything else online using third-party business people. But yeah, it's quite interesting. Back in 2009, I was reading here silently, the Roadster, I think they have discontinued delivering Roadster or have slowed down tremendously and just focus on Tesla Model 3s. Roadster this is 2009, 12 years ago. Roadster has an estimated average range of about 400 kilometers per charge. So how much is that? 248 miles. This is back in 12 years ago. So they were already able to develop a technology could go 200, almost 250 miles per charge. And now,
and now it's about another 100 miles over that.
100 miles over per charge. So Tesla just reported their earnings, which gladly beat earnings estimates. So for the past 4 quarters, Tesla has beaten the Wall Street estimates 3 out of 4. Let's see.
So, with about less than 500 price to earnings ratio.
Quite pricey. For those who listeners that don't know, price to earnings ratio, how you look at valuation. Recently, it's better to look at the forward price to earnings. Do you have any information of forward price to earnings, Kuyawawi?
No, I don't have it pulled up.
But I'm pretty sure it's way up there because overall the S&P 500 is hovering around 17 or 19 times PE ratio at this point in time. But regardless, it's the future that you're investing in. If you have Tesla in your portfolio, looking at their revenue, it grew 57% to 13.8 billion. And what's more impressive is their margin. Their profitability has ever been improving. Now, gross margin is 30.5 versus 28% estimates. This is a quarterly update chart or graph from Tesla's investor relations website. Obviously, they're producing a bunch of their cars in Shanghai, more than almost 500,000 cars as status. And correct me. I want to correct there. California, they produce a lot of cars in California, which hovers around 600,000 cars there in California, compared to Shanghai, which hovers around above 450,000. Berlin is still pending in construction, and obviously the Gigafactory in Texas for Model Y is still pending. So the market share of Tesla vehicles, despite the ongoing competition from other car makers, it's still ever increasing as of this time. So it's US and Canada, it's nearing 2%. And for the rest of the world, it's about 1 to 1.5%, which is pretty impressive.
Yeah, on a side note,
is building up.
I would like to add a side note there. So Tesla is building this factory in Austin and Berlin. Berlin is slowed down by environmental concerns,
right?
But should start production next year if they pass all their inspections. They should produce about 1 million cars on each of those factories.
Wow!
When they're fully ramped up. But what got on my radar today, early this morning, was Saudi
Mm,
Arabia is looking at uh, attracting EV manufacturers into their country.
mm.
So we don't know who's gonna get first dibs, but I'm thinking Tesla would be
Oh yeah,
part of, yeah, one of
no
those
doubt.
companies. So they're trying to diversify their country's economic power. Right now, of
Right.
course, is oil,
Oh
Saudi
yeah,
Aramco.
number one.
So looking forward to that
Mm,
development. So we'll see a big change in the Middle East if that ever
right.
happens,
Yeah,
and may
they have
change the
lots of
whole.
sun over there too.
Oh yeah, exactly. I didn't
Solar.
think about that. Yeah.
Mm. So I
So
think at
that
one point,
technology.
sorry, go ahead.
So that technology, both EV cars and maybe solar power, might see a new
Mm,
burgeoning growth somewhere in the Middle East.
yeah, I believe that's not far from happening for sure. And at one point, I think I know, before that Jamal Khashoggi killing, few years ago, Musk was actually in a conference talking to the prince or the soon-to-be king.
Oh.
And then that happened, and then some people pulled back, and now I think past 3 months I saw some news that slowly businessmen are coming back into circles with the Saudi Arabia empire.
Mhm.
So here's an outlook from the company. So obviously, Musk is still heavily focused on producing more and more cars. They're saying that their outlook is including an expectation to achieve at least 50% average annual growth in vehicle deliveries. Also, what's more important on this slide is that in terms of their cash or their balance sheet, they say we have sufficient liquidity to fund our product roadmap, long term capacity expansion plans, and other expenses. On their profitability outlook, they're saying Tesla is expecting their operating margin, which is um, better metric compared to gross, will continue to grow over time, continuing to reach industry leading levels with capacity expansion localization plans underway. And their products continue to target first Model Y in Berlin and Austin before the end of this year. Successful introduction of many new product and manufacturing technologies in new locations, ongoing supply chain related challenges in regional permitting. Tesla is making progress on the industrialization of its Cybertruck, which is currently planned for Austin production subsequent to Model Y. Oh, okay.
Yeah.
So Cybertruck will be coming out or be produced in Austin. Interesting.
Yes. Uh-huh.
So nonetheless, I would say Tesla is in a good roadmap at this point in time. They have good balance sheet, as they say. So here, I was interested because they mentioned about their cash status. So their cash as of September is 16 billion, and their debt, customer deposits, debt. Here we go. Debt and finance leases, portion one, 7.9 billion plus. Huh, that's it. 7.9 billion. Oh, here. Total debt excluding vehicle and energy, 3.9 billion. Wow. And then their cash, what is it? 16 billion. No
Mhm.
kidding.
They're
Company
float.
is,
They're
yeah,
floating in cash.
they have a bunch of cash laying around. Debt and finance. Let me double check. Okay. So debt, finance, leases, net of current portion, total liabilities, current portion. So 1.5. Okay. And then 7. I think it's, okay. Here we go. So 7.9 billion in their long-term debt, and then 1.5 billion. If we're going to add that, 7.9 plus 1.8, 1.5, 9.4. So they have 9.4 billion in debt while they have 16 billion in cash. Man, Tesla is cash rich at this point of time.
Mhm.
um, okay, well, I'm done with the Tesla conversation. Now we have
Mhm.
Google. As you may have known, our listeners, this week has been quite a hectic week. There are a bunch of big tech that have announced their earnings, including Snapchat and Facebook last week or this week. Uh, Facebook, by the way, just changed their name to Meta, at least the company name, to at least spread awareness of what the long-term goal is for the company. So this is not uncommon. Google also have renamed their parent company or their company to Alphabet back years ago. This is to further, make awareness of the investor of what their long-term plan is. So before we jump onto Facebook, we have Google here. Google achieving new all-time highs. It reached about almost $3,000 a share just yesterday. So they came out with their earnings. They beat their earnings expectation. They also, unlike Tesla, I think Tesla missed their revenue estimates. No, they beat their revenue estimates as well. So Google beat their earnings and revenue estimates. They beat at least for the 4 consecutive quarters. And looking at their closely, as here entitled, Alphabet shares hit all-time high, edged closer to 3,000. This is a couple days ago. So the shares climbed 7% to $2,900 a share. What's interesting here is because back in a few months, I think early first quarter of this year, as we were discussing meanwhile on our early podcast, Apple has changed their iOS software where it kind of like asks the users if they're gonna allow an app to track them down, and this indirectly affects big tech companies, especially those who are marketing or search that helps other businesses get their products in front of their potential customers because of their tracking capabilities have been slowed down, definitely not hitting those people who may or may not be interested on their products that have opted to the tracking software of the iOS. So according to the YouTube's CFO, the iOS policies that have been updated have just had a modest impact to their results. As we can closely look at their numbers for the quarter ending in September 30, 2021. So quarter means 3 months. So the 3 months that just ended on September 30, revenue or sales in Google still grew by 41%. So that's an impressive growth. Compared to last year, 46 billion, they're now sitting at 65 billion sales. And operating income or operating margin has grew by 8% to 30, not just 8%, but 8/24. Operating margin grew by 33%, nearly a third to 32%. So Google even grew their profits. They've even become more profitable despite the iOS change policy. So according to their CFO, Ruth Porat, our consistent investments to support long-term growth are reflected in strong financial performance. With revenues of 65 billion in the quarter, we continue to deliver across our business by providing helpful, valuable experiences for both consumers and our partners. So YouTube, let's look at this. This is the up and growing section of the company. Grew by almost 2 billion. Google search, which everybody else knows, this is the main business of Google, grew almost $12 billion year on year. And Google Cloud, which they're trying to compete with Amazon, which is still a tiny bit of their business, grew 1.5 billion. So it's ever increasing. Total TAC, which is their traffic acquisition costs, a critical metric. So this is what they expend to gain traffic to Google websites on apps and websites. It also increased. The expenses to gain traffic has increased by almost 3 billion. Nonetheless, their profitability has still increased over time. So knowing me, my favorite metric as well is the cash. So Google's cash since December of last year to September has grown by 6 billion from 136 to 142 billion. So company is solid in terms of their balance sheet. Long-term debt is 14 billion. So that definitely is just a minute part of their balance sheet. 142 billion in cash. That's one Warren Buffett there. Warren Buffett is 105 billion.
Yeah, and if you look at
Mhm.
revenue by Google, you should see that a lot of it is going through advertising. With the move of everything moving away from traditional, broadcast network into the internet, Google has really trapped all that revenue, funneled all that revenue into their system.
Right.
Yeah,
Well,
with all that advertisement going there.
mhm.
And they
I want
have developed this ecosystem, right? Where
right.
people are engaged and people are earning as they're posting on YouTube, as being influencers and stuff like that,
Mhm.
which were, somewhat a part of that, but we're not earning.
Right. Yeah, well, we're just doing this, as a hobby. Once a week we try at least share our thoughts and insights on stuff that's happening on Wall Street. So,
Hmm.
if you guys like what we're doing, hit the thumbs up button and subscribe.
Yes,
You know,
and leave your comments.
leave comments and suggestions. Send us some feedbacks. So yeah, Alphabet and Microsoft rise to records after quarterly earnings beat estimates. Oh, Microsoft has been like a silent part of of this big tech world. They're probably they're off news wires. They haven't
Hmm.
made any big splash in litigation, or unlike Facebook or Google or Apple, which have been called to Congress just within the past year. And
Yeah, no news is good news. They're
one news is good.
quietly growing.
Yeah, for sure. Sundar Pichai, he's leading Microsoft really well at this point in time. So Microsoft has a market cap of 2.43 trillion. Is fast approaching Apple's 2.46. And as of this morning, right, Apple's falling. So
Yes.
maybe
Hmm.
Microsoft may overtake Apple, silently overtake Apple's throne as the most valuable company in the world at 2.4 something trillion dollars,
At least for this quarter.
at least for this quarter. Yeah. So Ross Sandler, analyst from Barclays, noted yesterday, quote unquote, the ad market remains strong. And unlike most digital peers, Google uh, doesn't seem to be negatively impacted by iOS 14 or supply chain issues, which is really good to hear. Longer term, Google remains the best positioned company in digital advertising and one of our favorite names. Revenue at meanwhile, Microsoft, let's look at that. Revenue at Microsoft increased 22% to 45 billion. So how much did Google grow? Google 43%. Wow. They're neck and neck. No? No, Google grew faster, 43%. Sorry. 43% for Google, 22% for Microsoft, albeit a little slower, but still at $1 billion, growing at that speed, 45 billion. I mean, how can you complain? I remembered us talking about these results too while we back in June, that most of these CFOs are already forewarning or warning their investors that there's going to be a slowdown coming. But 43% for Google and 22% for Microsoft, that's not a slowdown. I mean, it could be a slowdown, I guess, coming off COVID lockdown. But man, these companies that grew, their fundamentals, business growth supports their valuation, in my opinion.
Yeah, I agree.
So
Yeah.
UBS analyst, uh, quote unquote, says Microsoft overcame the two key concerns heading into the print, the PC exposure and margins. So while investors are bullish on Google and Microsoft growth prospects, both companies signaled potential challenges ahead. So this is not new. Potential challenges, they have been warning their investors back in June. So the stocks are up 83% for Google and 51% respectively in the past year. Wow.
I
So
think the challenges will be like increased competition amongst them,
yes.
these big network companies.
Yes.
Microsoft has done good with Azure being adopted by businesses, and its
Mhm.
cloud infrastructure is getting as strong as Amazon.
Right.
So it will be, I think the slowdown will be their competition against each other.
Right. So I think it's for sure it's AWS. Amazon's AWS, the top leader in cloud, followed by Azure and then Google. And then I think Alibaba is close to within reach within that the top 4, top 5 position.
The big winners here will be the developers
Mhm.
on those data centers and the security infrastructure developers.
Mhm.
So you're looking at,
Mhm.
CrowdStrike,
CrowdStrike, yeah.
hmm
Those are security firms,
Palantir, maybe.
Palantir. Yeah. But yeah, the one thing to highlight on this paragraph here is it's on this article is the last paragraph. Analysts expect a slowdown in revenue growth into the first half of next year for Google, due in part to lower fees in Google Play and regulatory challenges. So, just a couple of weeks ago, Google announced that they're gonna cut their commission from their app store to 15% from 30. So this is what happened to companies that weren't able to adapt to Apple's iOS changes. Snapchat for the past month had fallen 24%. And if you're going to look at by the time that they announced their earnings last week, October 1st, their stock is down 20, almost 28%. This is because they weren't able to adapt to the iOS, leading to their Wall Street miss estimates. Um, and they weren't able to really adapt to it. So their stock dove 30%. Although if you're gonna look closely at their numbers, their revenues is still like rising crazily strong.
Mhm.
Snapchat's revenues rose almost 60% and landed at 1.07. But the thing that sent his stock price down is they missed the expectation. Not so much though. Expectations were 1.1 billion. They reported 1.07 billion. It's not like half. And their operating losses widened to 180 million. So I guess Snapchat is still not profitable. And now iOS is changing their policy. So that could further hint a possible difficulty in the coming quarters. So according to the CEO, Evan Spiegel, we are now operating at the scale necessary to navigate significant headwinds, including changes to the iOS platform that impact the way advertising is targeted, measured, and optimized, as well as the global supply chain issues and labor shortage impacting our partners. So I guess the first one is directly related to their business. And then the global
Mhm.
supply chain, I don't imagine Snapchat delivering any goods or services. They're not selling any products, but yeah, global supply chain issues, labor shortage impacting. So they're highlighting their partners or the whoever uses their services encountering
Mhm.
deficits. So, but I'll focus here more iOS exposure.
I think there might be a shortage of software programmers.
Could be, or they just need to pay up
Hmm
more, increase their salary, as everybody else is doing it if they want to achieve quality applicants. So here's an article from Barron's just last night. Amazon. Now we're jumping, so we jumped. So Tesla wonderfully beat their Wall Street estimates. Google also wonderfully beat their estimates.
hmm
Uh, and then now, oh well, Snapchat, of course, they didn't meet expectation, but it's not that quite bad. And now we're jumping on to Amazon. Amazon, here's an article from Barron's last night titled Amazon Earnings Missed on Nearly Every Metric. And the stock is sliding. So let's look at this closer. So Amazon's stock had lower as they announced their results last night for the third quarter. Amazon reported sales of 110.8 billion, up 15%. So it's still quite a good amount of, increase from last year. A little bit slow, but it's still in line with its guidance. It said back in the previous quarter, I remember this, that they're gonna see through around between 106 to 112 billion. So 110.8 billion is within that range. But Wall Street is expecting 112 billion. So they missed it by about 2 billion, which isn't bad. Operating income was 4.9 billion, which is also in the middle of this guidance range of 2.5 to 6 billion. And its earnings per share, which Wall Street definitely looks closer into, landed on 6.12 a share in the quarter, well shy of Wall Street consensus is 8.92. So more likely it's because it missed Wall Street estimate. It didn't miss its own guidance. It missed Wall Street's consensus estimates. So that's what's it's sending its stock price down. There's a little bit of reality check that should happen right now with Wall Street consensus, but yeah, I know.
Yeah, Wall Street is used to Amazon, you know, beating their earnings per share estimate all the
Right.
time. And this is like a break from that norm where Amazon is beating their estimates all the time.
Mm.
I think it's just choke point. There's choke point in supply,
I know.
and Amazon is doing everything. Sounds like, and looking at the news, they're buying more planes. It seems,
Yes.
and they're kind of. I mean, they're their own UPS now.
They have their own, yeah. They can
With
even
their
build their own
planes.
freight system or whatever.
Their main problem is labor.
Right.
Their workforce is demanding more pay,
More pay.
better conditions.
Yeah. So here's a quote from Amazon CEO Andy Jassy, quote unquote, "We've always said that when confronted with a choice between optimizing for short-term profits versus what's best for customers over the long term, we will choose the latter." And you can see that during every phase of this pandemic. The company will do whatever it takes to minimize the impact on customers and selling partners this holiday season. It'll be expensive for us in the short term, but it's the right prioritization for our customers and partners. So, for the fourth quarter, Amazon sees its revenue between 130 to 140 just in 3 months. 130. So, if we're going to divide that in 90 days, I'm just interested how much they're expecting to generate per day. So they're expecting to generate $1.5 billion in sales per day starting today or starting October 1st. 1.5 billion. However, look at this. Again, Wall Street is expecting 142 billion. So that's again above their range, which they might not they might not meet because of supply chain challenges. Not because customers don't want their products. It's because of supply chain. Products are not there to be delivered. Amazon sees operating income in the quarter from break even, like zero, break even, no profit, to 3 billion. Again, below expectations, which is 7.7 billion. Oh my. So this is like nearly doubled what Amazon is projecting. Wall Street is expecting too much from Amazon at this point in time, in my opinion.
Well, that just tells you how bullish the sentiment is for Amazon.
Right.
The expectation is high, its valuation is high.
Right.
I mean, it's still undervalued as a company, and it has a huge cloud market global. So we're not seeing, what's underneath the iceberg yet. I think next year, if everything normalizes, then we will see, Amazon getting back to normal. Valuation will hit its actual, estimate. And if you have good conviction on Amazon, I would say, well, this might be a good time to, increase your position.
Right now, it's selling for $3,200 a share, down 5% yesterday. So online stores, which Amazon is well known for, their 2-day shipping, for this quarter that just ended, grew 3% to almost 50 billion. As you may have known, fell
Mhm.
shy of Wall Street consensus of 51 billion. So these big tech companies, I remember Google generating almost oh no. So look at this. I would just want to look at Google's.
Yeah, and I think Amazon built another hub somewhere in South Dakota to meet the
Mhm.
the 2-day, 1-day delivery. So
Yeah,
they built two uh you know two warehouses
right.
on the northern part of the states.
So they're trying to definitely expand more. But yeah, as I was going back to Google, so Google generated 65 billion. That's their total business for the quarter. While Amazon, just by its online stores alone, generated nearly 50 billion. This is excluding other stuff like the cloud services, like here. So online stores of Amazon alone matches what Google is generating on their Google search and YouTube and all that. But regardless, it's nothing to it's not an apples to apples comparison because Google's business is more profitable in terms of that segment. Um, Amazon doesn't generate as much profit in their online stores. And as we have discussed in our previous episodes, Amazon gets most of their profits from this segment, Amazon Web Services. So for Amazon's web services, it grew nearly 40% last quarter to 16 billion, above Wall Street estimates. I guess that's the only only part of Wall Street estimates that they beat. Subscription revenues 8.1 billion. Oh, there's another one, just up, just ahead of Wall Street expectations. Physical stores, wow, tiny part of Amazon's business, 4.3 million. Jeff Bezos can have a hiccup and just cost him 4.3 million. It's nothing, just there. So here is what it's part of their press release. So they're warning that they may have zero profit this coming quarter, which would not be a shock to us who are already reading through their press release, but might be a shock to people who are not looking at this closely. And Wall Street, of course, whoever, and an average, they're projecting 7.7 billion compared to zero. So that's a clear big difference right there. So just a heads up in the coming quarters for sure.
Or the
Amazon's. Mhm.
I think going back to Amazon, yeah, I think their physical store is like a beta test for
Right.
the future stores, the store of the future.
Yeah, I think that you just have to use your phone and log in, and then you can just go pick whatever and put it in your basket and just go out. And they will just charge your, if you're a Amazon Prime member, he'll
So
just
it's
charge.
interesting how this will work out.
Mhm. So Amazon's holiday quarter, the coming quarters. Today is October 29th. So yeah, this is it. Last 3 months of the year, this is the busiest period of the year for Amazon for sure and other retailers. Holiday quarter sales forecast suggests pandemic boom is over.
Woo! Thank goodness.
It might not be a good sounding article though. Pandemic boom is over. So there's a slowdown coming for sure. Company will spend several $billion extra in quarter. Forecast revenue profit fall short of analyst estimates. So we don't have to dive into that because we were just discussed that. It will be just repeating ourselves. So now we're done with Amazon, we're done with Google, we're done with Snapchat, we're done with Tesla. We have Apple. Apple stock. This is an article from Barron's last night. Apple stock tumbles after a rare sales miss. Investors aren't happy. Are you happy on Apple, Huawei?
I don't have Apple.
Oh, you
My
do?
sister-in-law likes Apple,
Really? I thought you had
but
Apple.
no, I should buy it now since the pricing is good.
I'm happy with Apple. If you're gonna ask me, I'm happy with Apple. So for the quarter that just ended, Apple posted a revenue of $83 billion, up 29% from last year, shy of Wall Street consensus 84.9 billion. I mean, what can go? Oh, what else can go wrong? That's just asking for too much. 83 billion, up 29%. And profits were earnings per share landed at 1.24, $1.24 a share, in line with estimates. So they missed the top line, but they met the Wall Street earnings per share estimates. Company had warned 1 quarter earlier that the component shortage could affect some product categories in the quarter, and that may have played a factor of results. iPhone sales up 47%, nearly 39 billion. But again, shy of Wall Street consensus of 41.2. iPad sales up 21%, below Wall Street. Mac sales 9.2, just above Wall Street's consensus. Wearables, or the watch. Is iWatch or Apple Watch? Apple Watch? Wearables came in light, 8.8, below Wall Street estimates. Overall products up 29.8% to 65 billion.
iWatch is, let me say this, iWatch is
Yeah.
old, right?
iWatch.
iWatch is old. I think the new, the new revolution revolution. I hate to use that word. The new tech coming, it would be more of AR, VR.
Virtual reality.
Yeah, I mean, Apple has that technology. I don't know why they have not released that. I think, yeah, since you mentioned, you just reminded me, I need to look at Apple again, right? And seriously consider, holding positions on Apple, because
Yeah.
that's where this is all headed. Okay, well, I don't want to jump on our discussion, but anyway, just AR and VR. Okay, just remember that when we
The
talk
future.
about, yeah, the future market is AR and VR and
Yeah.
wearables.
Yeah. Services revenue for the company, for Apple. This is including their App Store and stuff. Bright spot, 18 billion, up 26%, well ahead of consensus estimates. Meanwhile, CFO, let's see here. CFO Luca Maestri said on the call that Apple expects the revenue impact from supply constraints in December to be larger than it was in the September quarter. So here we go. Amazon is forecasting zero profits, and Apple is seeing larger impact on this December quarter. So CEO Tim Cook added that sales in the latest quarter, oh, this is going back to the recent one, okay? Tim Cook added that sales in the latest quarter affected the iPhone, iPad, and the Mac. And now, on the coming quarter, for this quarter, he thinks the largest issue will be chip shortage, with manufacturing issues in Southeast Asia easing. So nonetheless, we're looking at lower profitability potentially in the coming quarter. So the CFO also said that the company, Apple, expects very solid year-over-year growth in the December quarter. So I'm confused now. With growth in all areas except iPad due to supply constraints. Services revenue growth is expected to decelerate from the most recent. Oh, so this is one thing to keep an eye on. So services, which we would think unaffected by supply chain because people just download and pay whatever the app charges, expected to decelerate despite the CFO saying it's going to be having a very solid year-over-year quarter in December. So I'm quite confused in that narrative. So here.
Well, you look at it this way. They haven't released, they released the what you call this, i14?
iOS 14.
iPhone 14, is
Oh,
that
the
it?
iPhone? Yeah, I don't keep
A
track.
new iPhone. Yeah, so they released the new iPhone, but it got stalled because of the supply chain, right? So sales may have not reached its target. But look at this, they haven't released any new products. They have a lot of products, on the back that they haven't released yet. I wonder what they're doing. Maybe they're testing it.
Testing the water.
So yeah, so revenue may be slow, but if they release their new interactive products that will deliver a new experience to their customers, then again, I'm jumping the bandwagon here. Facebook is already ahead by doing their uh,
Metaverse.
the metaverse, right?
Yeah.
But Apple is somewhat ahead of this curve. So I
Mm,
wonder why. Well, uh, well, Facebook got ahead, but I'm pretty sure Apple has the technology
right.
to, to jump ahead.
Mm.
That's just me. That's
They
just
do have,
me.
yeah. They have the hardware already,
Yep.
but we'll see because Facebook also have their headset. So for the quarter, last quarter, Apple bought back 20 billion worth of its stock through share repurchases, but still ended the year with 66 billion in net cash. So in total, they have 191 billion in cash, almost 200 billion dollars, almost one Elon Musk. Oh no,
Mm.
not even. Elon Musk is 302 billion dollars. Nope, that's not a good comparison. But 191 billion is still a good amount of money. And they have 125 billion in debt. So if you minus 191 minus 125, they still have 66 billion in cash. So all over the world, Apple grew 20% their business, their sales, 20% in the Americas, 23% in Europe, 83% in China, their fastest growing area, and 26% rest of Asia Pacific, 20% in Japan. So for the full fiscal year, meaning for the last 12 months, Apple generated a revenue of 366 billion, up 33% in the past year. 366. Sooner or later, that will be an Elon Musk figure right there. 300,
I think so. I think
360
so.
billion. It's not far from happening.
Not far. There's Asia is a huge market.
So Apple, it says here, this is another article from Bloomberg last night. Apple tumbles after supply crunch hurts iPhone makers' sales. So constraints hurt Apple's revenue by 6 billion last quarter. Not a tiny drop, but still, CEO Tim Cook, as we have already discussed, says current period, this quarter, October to December, will be even more challenging. But Wall Street expecting still that Apple would generate a good amount of money. They have to revise that for sure. Earnings revision is a must at this point, I believe. So we're done with Apple, we're done with Google, done with Tesla, and a bunch of others. Now we're going to Facebook.
Meta.
Meta. So yeah, I think they're gonna change your ticker, MVRS, starting next Monday. That's fast.
Mm-hmm.
So for the past 4 quarters, Facebook have been able to beat Wall Street expectations quarter after quarter. Facebook is a nonstop Wall Street earnings estimates beating machine.
It's amazing. Facebook is amazing. Unbelievable.
Unbelievable. Now it's Meta.
Now
Meta.
it's Meta. I think it's app. I think that name is appropriate because they're in the engagement game, right? You have all these people, billions, global,
Yeah.
people using Facebook. The problem is a lot of them are, older, you know, like maybe like me, right? 50, 40, 50 years old. So they need to change their approach, to attract younger engagement
It sounds like
to their
a
platform.
cryptocurrency, Meta.
Yeah, so this is what I talked about in the group. So it's
Mhm,
similar to what Decentraland was trying to do, which
mhm.
is, you get into a metaverse where you can buy real estate, build your store, show a
Right.
product, have a show.
Mhm.
So Decentraland came with this, and now Facebook is going to do it.
Yeah. And
and
oh,
and they have Novi. Novi is the currency that uh, Facebook will be using in this
Novi.
universe, yeah, in this metaverse. I know they came up with Lira in the past,
Ah,
but
yeah,
that
Facebook
did
Lira.
not did not get any adoption. That was, I guess, too much ahead of its time for
Mhm.
regulators to consider. But now that cryptocurrency is, well understood, I mean, by a few, and it's growing adoption, and people are starting to understand what it's all about. Now they have the Novi wallet, and we'll see how
Mhm.
this goes, because this will kind of trend, the future jobs of the future, right?
Yeah.
We
Future.
don't know.
Yep.
We don't
He's
know what jobs will be existing in 2030.
right.
85% of possible jobs are not yet known for
Hmm.
2030.
Yep. That's an
Facebook
interesting
might
point. Yeah.
Facebook might
Mhm.
Facebook might, you know, uh, develop these new jobs that we don't know yet.
Right. Because I think for this year alone, or for the coming year, they're going to be allocating at least $10 billion worth of funding for this metaverse plan. So it's not a chump change. It's going to be a good amount, and they're talking about it seriously, doing it. So it's going to come up
Mhm.
pretty soon. So going back to its previous quarter, Facebook, they beat their revenue estimates or sales. Oh no, they missed. I'm sorry. Revenue, they missed by 500, half a billion. They missed by half a billion, but still, they grew by 35% to $29 billion. They also missed their monthly active users by about 100 million. Now, Facebook monthly active users are now hovering around 2.91 billion. 2.91 billion people are using Facebook every month. And
That's what
daily,
they're trying to improve on. They're trying to improve on their active users.
mm,
They're trying to get more of the younger generation back in there.
I don't doubt it. Yeah, it's possible. Instagram is still, I think, in a craze, it's still in the trend. Daily active users, 1.93 billion. At least 1.93 billion people uses Facebook, Instagram, WhatsApp on a daily basis. So CFO commentary, quote unquote, ahead of the fourth quarter earnings call, we will share additional details about segment. We expect, so this is their expectations for this quarter, the coming quarter. CFO expects fourth quarter 2021 total revenue to be in the range of 31.5 to 34 billion compared to Wall Street, again, 34.8. So Wall Street's expectation is again higher. Outlook reflects significant uncertainty we face in the fourth quarter in light of continued headwinds from Apple's iOS 14. So, along with Snapchat, Facebook is definitely saying something about the Apple's iOS changes and macroeconomic and COVID related. So these two are given, obviously. In addition, we expect non-ads revenue to be down year over year in the fourth quarter as we lap the strong launch of Quest 2. What is Quest 2 even? Have you heard about this Quest 2, Huawei?
No,
What is that?
no. Let's look it up. Let me Google it.
I'll have you look it up while I discuss the expenses or
Okay.
the future. So for the quarter, Facebook sees the tax rate. Oh, that's fine. There's always death and taxes part of the profitability of a person in a company. So according to Mark Zuckerberg, Facebook founder and CEO, quote unquote, we made good progress this quarter and our community continues to grow. I'm
It's their
excited.
sorry,
Oh,
it's
go
their
ahead.
VR hardware. It's talking about their VR headset
Oh,
hardware.
yeah. So they're
That's
making
the Quest
strides.
2.
Okay. So Zuckerberg says, I'm excited about our roadmap, especially around creators, commerce, and helping to build the metaverse.
Ooh, that is gonna be a new, well, intangible, right?
Yeah, for sure.
Market right there.
So here's an interesting part of their discussion of their earnings. CFO outlook commentary. Starting with our results for this quarter, fourth quarter, we plan to break out Facebook Reality Labs, FRL, as a separate reporting segment. So this is something to keep an eye on. This is probably where Quest 2 and other stuff will be falling in, the metaverse aspect. we are dedicating significant resources toward our augmented and virtual reality products and services, which are important part of our work to develop the next generation of online social experiences. So there will be two segments. The first segment is the family of apps, which will include Facebook, Instagram, Messenger, and WhatsApp, and other services. And second segment, Facebook Reality Labs, which will include augmented and virtual reality software. We expect our investment in Facebook FRL to reduce our overall operating profit. So this is going to be significantly affecting Facebook's profitability for this year by 10 billion already. So this hasn't been discussed in Apple, Snapchat, or Google, this augmented reality. So Facebook is definitely going head on and invest a bunch of money in this eventual, future, the metaverse, which is still quite interesting. I can't wrap my head around it. Maybe I'm thinking, somebody said this over the radio, that maybe this is how the future is going to be. Like, people will be staying at their homes. They haven't gone over their work from home experience. So they're going to put their headset on. And for students, for example, high school students, they're not going to be only reading Shakespeare works. They're going to be watching Shakespeare as he discuss, the quotes and aspirations as to why he have been able to make such unique and memorable ideas and quotations during that period of time. It's like going back to wherever you want to go and just witness what had happened on that specific, which is quite interesting, right?
Yeah, well, if you look at toddlers interacting with cell phones right now, they're virtually in a virtual world. They know how to maneuver the screen,
right?
So this is part of experiential learning. So you adapt to your environment. So if you're given a tool, a human being will use that tool.
I believe that.
And then Facebook is, oh gosh, I don't know what term to use, but probably gonna monetize that experiential environment learning. What else, right? So just going back to Decentraland,
right.
Part of the Decentraland thing is that's a blockchain blockchain development where people can go in as virtual people inside a metaverse. You can buy real estate, right? You can exchange tokens, you can exchange coins, you can buy NFTs. So it's just the limit of the imagination is just kind of like you're in a game, right? So you're in a game world, and then
this kind of reminds me of that movie Ready Player One. Not sure if you've watched that. They just
I didn't watch it, but there are a lot of movies like that, like Tron.
Yeah,
right?
Tron.
In my generation.
Yeah, and they go. I watched the Tron too, Tron Legacy in 3D. I remember.
So now we're in that system where they're monetizing that kind of experience,
right?
And I don't know. We might be surprised how well this may be adopted or not by this future generation that's already tech savvy.
I think Mark Zuckerberg is betting billions that it'll happen. So, cheers to that. We'll see.
We'll see.
Yeah, sorry about the noise because we're doing remodeling in my home right now. So if that bothers you, I apologize.
Ooh, that's a good sound of growth.
So yeah, we're about 3/4 done in our segment today. So now we're gonna dive into, more importantly, like growth. Like, you're gonna look at the economy as a whole of the U.S. market or the U.S. economy. So just last night or yesterday, U.S. economy registers lower growth rate to 2% on a. This is an article from CNBC entitled "Economic Growth Rate Slows to 2% on a Sharp Slowdown in Consumer Spending." So for for you listeners who have been listening to us for the past couple of episodes, we've already pointed this out last month. Consumer sentiment has dropped the sharpest. In fact, I have the slide pulled up in a few that will show you when was it exactly that we have discussed it. But yeah, there was a sharp slowdown in consumer spending, reflected from declining consumer sentiment because of higher prices. This was initially indicated by a strong drop in what do you call that? The vehicle sales, right? While the vehicle sales have slowed down a month ago, and it's because of the
Yes.
ever higher prices. Um, U.S. economy, according to CNBC, grew at a 2% annualized pace this third quarter, the slowest increase since the end of the 2020 recession. Decelerations in consumer spending and residential investment help keep the number lower. Weekly jobless claims, so this is a good sign. Jobless claims fell more than expected last week to a fresh low of 281,000, below 289 estimate. So definitely GDP is slowing down.
Mhm.
Um, this is the slowest since the 31 point. This is incredible plunge. This is back last year during the lockdown when they locked everything and nobody can get out and spend. So quite a drop there, 2%. So heading on to our next slide. So this is what we have discussed back in August, more than a month ago, when consumer sentiment fell the lowest since 2011. So as a result, a month and a half later, it has reflected on real numbers. So according to Paul Ashworth, chief US economist at Capital Economics, quote unquote, overall, this is a big disappointment given that the consensus expectation at the start of the quarter in July was for a 7% gain. And even our own bearish 3.5% proved to be too optimistic. So now these economists are probably in shock, now that we're at 2%. Quote unquote, we expect something of a rebound in the final quarter of this year, if only because motor vehicles won't be such a drag and any negative impact from Delta should be reversed. So he's still expecting a rebound in the final quarter, fourth quarter. But the problem is, big tech, respectively, they're already expecting a slowdown. We haven't taken a deep dive with GM, General Motors, and Ford, which I would like to, but that will push our podcast into a 3-hour, 4-hour discussion. So we're going to skip GM and Ford this week. Maybe we'll get back to them next week, which is quite important, I believe so. Because
Yeah, let's just say Ford did really good this earnings season and for the year.
right. And from what I saw is like they reinstated their dividends. So
Yes,
kudos to
they
them.
did.
They finally got their dividends back, paying out. So investors are happy with that. But yeah, definitely Huawei and we already discussed what the expectations are, except for Tesla for this podcast. Everybody else is seeing lower growth and even no profitability for Amazon this quarter, this December quarter, which usually is the other way around in terms of, if there was no COVID lockdown, this quarter usually is the most productive quarter for retailers. But it's the reverse right now because of the supply chain issues, which indirectly caused by COVID again. So surveys. So August we are at a sharp drop, right? So September it bounced back up to 72.8. The sentiment I'm referring to, sentiment of consumers. And then in October it went down again to 71.4. So year over year, consumer sentiment has dropped 13% already. So current economic is down negative 9%, and consumer expectations is hovering around 67%, which is down 15% from last year. So consumers are now not as optimistic as a year ago. So we're briefly gonna highlight some of real estate findings that we have had for the past week. We're done with looking at the consumer aspect. Home prices in August. This was published 2 days ago, but they're discussing the August real estate market. Hinted at a possible cooling in the market. S&P Case-Shiller says. So looks like we're gonna see a little bit of slowdown in real estate.
I think
But
we're already experiencing that.
mhm,
Mhm.
they've been cooling off, red hot. So for August, there was still like house prices still rose almost 20%, which was the same as the previous month. So I think it's been going trending up, and now we're a little bit flatlining. But 20% is still a lot. nothing, nothing to take out of context, but it's still like a good amount of jump for house prices. Quote unquote. August data also suggests that the growth in housing prices, while still very strong, may be beginning to decelerate. Craig Lazara of S&P. So according to him, we have previously suggested that the strength in the US housing market is being driven in part by a reaction to the COVID pandemic as potential buyers move from urban apartments to suburban homes. August data also suggests that the growth in the housing prices may begin to decelerate. Phoenix, San Diego, Tampa, Florida saw the highest year-over-year gains among the 20 cities in August. That's being monitored by S&P 500. Phoenix led the way by 33% year-over-year price increase. San Diego 26.2, Tampa, Florida 25.9.
Yeah, that's interesting. I think just in LA, I just read something about the mayor of LA giving like $1,000 per year. I have to look it up again.
Like credits?
Anyway, yeah, they call it LEAP, LEAP. I just glanced through it, but I think they're just helping. He said he's trying to help his constituents
Right.
by
But into
giving them
house.
this extra money,
Right.
I guess, for the cost of living to stay in LA.
Hmm. So going back to the article, Selma Hepp, CoreLogic deputy chief economist, said, quote unquote, persistently strong demand among traditional home buyers has been amplified by an increase in demand among investors this summer, while strong home price appreciation rates are narrowing the pool of buyers, particularly first-time buyers. The depth of the supply and demand imbalance and robust demand among higher income earners will continue to push prices higher. So CoreLogic still sees higher prices in the near term. So this is one thing. You may or may not have heard, our listeners, Zillow has stopped doing their iBuyer because I think they hit their quota for this
Mhm.
year. So nonetheless, this is an interesting find by Business Insider. We're not a member, but are you a member of Business Insider, Wabi? This is just
No, I'm not. I'm not.
yeah, this is just a snapshot of the article entitled Zillow is selling hundreds of homes in places like Atlanta, Phoenix, and Houston. So Phoenix is a hot market. An insider analysis found almost 2/3 or 70% of those that are listed are for less than it paid. So they're taking a loss on these
Mhm.
houses that they use their iBuyers with.
Yeah,
So
so they can start moving along again.
right.
They
So
have
there's
they have
a
to
bunch of
get rid
houses.
of some. Yeah, they have got to get rid of their inventory.
Yeah. So that could temper demand as well. So we will see that because that was just published 33 minutes ago. And when I saw it, that's probably more than an hour or 2 hours ago. So after real estate, we're gonna. So this is the earning season right now. We're not gonna be discussing each and every company. We're just gonna look at them broadly of what they've been doing.
Why not?
So we got on this article by Bloomberg, we have McDonald's, Coca-Cola. So both of these companies, as you listeners may or may not known, these are companies that have their brand names in check. Meaning, if they want to raise their prices, their menu items, their your Coca-Cola cans, they can because they have the pricing power. So, market is appreciating what they're doing after they have increased their prices because their stock price are going up as their menu prices have been climbing. Like, for example, McDonald's and Coca-Cola shares jumped yesterday, the other day, after the companies reported rising demand, even in the face of price hikes. The restaurant chain, in particular, pointed to higher menu prices in the US, boosting comparable sales to almost 10% above Wall Street expectation. McDonald's CFO Kevin Ozan on a conference call said, quote unquote, "We haven't seen, I'll say, any more resistance to our price increases than we've seen historically." So consumers are liking McDonald's. They still like buying Big Mac quarter pounders.
They have healthy options too.
Yeah. And then Coca-Cola similarly has raised prices and said it will continue to do so to counter higher costs. So Coca-Cola is not done raising prices. So it's going to continuously adapt to the ever so growing inflation, which is at 5%, right? 5.2 for this year
Yes.
so far and annualized. So this is
Yes.
another article, Costco from Winsight Grocery Business. Costco reports strong sales gains, but higher cost pressure margins. So Costco, also a retailer, reported a growth of 14.9 on their comp sales, which is a metric for grocers, buoyed by higher traffic and greater spend per trip. According to the CFO, Richard, I know, this is Richard Galanti, EVP, Executive Vice President and CEO of Costco, quote unquote, "It's a lot of fun right now." higher labor costs, higher freight costs. I think that was sarcasm. Higher labor costs, higher freight costs, higher transportation demand, along with container shortages and port delays, increased demand in certain product categories, various shortages of everything from computer chips to oils and chemicals, higher commodity prices. And while we're not going to change the price of muffins every week, Galanti said, continued rising costs have pushed the company to raise estimates prices from to 3.5 to 4.5%, up from estimated 2.5 to 3.5. So they're definitely increasing their prices between 3.5 to 4.5 range.
Yeah, and
up
that's
from 1 to 1.5% back in February. So they're still increasing their price. Take
yeah,
note. Mhm.
yeah. Inflation is here.
So yeah,
Hopefully short term but the prices will remain high in my opinion, but there might be a surge maybe in 2 or 3 months
yeah,
because
and
of the choke points.
yeah, and while you saw that labor information, right? Data compared to the last year's in the ports. How much is it like in terms of being delayed? A bunch of them being holed up there in port.
Right now they said that there's like 60,000 containers waiting to be hauled out of the LA port. So
60,000.
60,000, and they're just waiting there to be hauled out, and they're being penalized
Mhm.
if they're there 9 days, more than 9 days. Each container will have to for each container they'll be fined $100.
Right. And this
And
is much greater than last year's, if I'm not mistaken, right, Maui? This is a growth.
yes, it is. I got my LA port pulled out here earlier,
Mhm.
but I was searching other things.
I think you mentioned about 20 something percent that had been, the containers, number of containers being stuck in LA port earlier.
Yeah, there's a
So
bunch.
this is just anecdotal, but I heard somewhere on the news that some of the containers that have delivered recently their products have molds in their products inside their shoe boxes because they've been held on by the sea for a long period
Hmm.
of time. So the products are being wasted at this point in time, and in the later on in the future, if this finally eventually ebbs down, then products will be delivered. There will be a bunch of inventories laying out there that nobody probably wouldn't want because of products not being up to quality. So this is something also to consider.
Especially those refrigerated goods,
Mm-hmm.
food items, they would be wasted.
Right. So moving on to our companies, U.S. companies. So we've tackled Coca-Cola, McDonald's, Costco. So entitled here, published a couple of days ago by Reuters. U.S. companies to keep prices high as supply chain headaches persist. New York, October 27, Reuters. The largest U.S. manufacturers, including General Motors, General Electric, 3M, and Boeing, face logistics headaches and higher costs due to bottlenecks. Agreed the hit to profits can be mitigated by charging higher prices for their goods. GM, General Motors CEO Mary Barra. It starts with really strong price. We were able to do very well with full-size trucks and full-size SUVs. We just can't build enough of those vehicles. Larry Culp, CEO of GE. I'm not sure we're yet at the place where we would say things are stable. It really is akin to playing a whack-a-mole. Harley Davidson said it increased surcharge pricing in the US to offset higher raw materials. McDonald's, we discussed that. 3M cut its full year outlook. It would increase product prices to combat inflationary and supply chain issues. Lockheed Martin dramatically lowered its sales expectations. Pandemic has hobbled the top contractor's supply chain. Well, I think it's been rampant everywhere. Companies are raising their prices. So moving on, we're almost done. Thank you for staying tuned with us. If you still like to subscribe, please support us or support our channel. Yes, Wawi, go ahead.
Yeah, and please leave your comments and questions if you have any. We surely appreciate that. Well, what's the common thing here, right? So the energy companies will benefit from this higher oil prices. You know, these ships, these trucks that would move things along, they need fuel. So and has the price of oil have gone up more than 80 now, Mark? Do you know?
Yes, we have that on our chart.
So in just a few days, in just a few days, we were predicting maybe next month, but
I think, yeah, we have a video coming up shortly from what's his name, from CNBC, the regular the person who's being interviewed, Tom Lee, sharing his thoughts about oil. I think he's projecting more than $100 per barrel.
Yeah, it's looking like it's going to be more than 100.
Sure. So now we're jumping on to the bond segment. So this is just a minute discussion. So now we have companies, big tech companies, warning of slowdown. We have consumers sentiment dropping. We have what is that? Slowdown in GDP that was announced just yesterday, much lower than what economists were expecting. Bearish was 3.5. We registered 2%. And now bonds are moving awkwardly. They're flattening. So this is an article from Market Watch published a couple of days ago titled "Bond Traders' Mood Turns Sour as Yield Curves Flatten All Over the World." So not just US. So what's next after a flat curve? It could invert. So whenever an inversion happens, it's a precursor to a recession. So I'm not saying that we're going to have a recession next month or next week, but it's something to keep an eye on. Federal Reserve, as a result, so I'm just summarizing what I've read here earlier. Federal Reserve needs to hike rates, in short, pretty much soon. Because if not, something can happen and we are finally going to have inversion in yield curve or something like that. So the spread between, according to the article, spread between 2 and 10-year US yields narrowed to a level not seen in 2 months on Wednesday. As long-dated yields slipped, shorter ones continues to rise. Counterpart gap flattest since March 2020. The moves come just a week before Federal Reserve is seen as announcing the tapering of its $120 billion in monthly bond purchases, a prerequisite first step before lifting its policies interest possibly next year. So hopefully they kind of like change the equilibrium once they announce this 120 billion reduction in monthly purchase. So expert Royce Terholz, I massacred the name, said via phone, quote unquote, around the world, we are now seeing central bank pricing get pulled forward, which multiple hikes expected for Canada, Australia, and Norway. The market is now coming to grips with the potential for a global rate hiking cycle beginning next year, whereby you could see the pace of tightening increase. So next year would be as so we've been in a loosening policy all over the world. So next year he's forecasting a tightening cycle to begin. But central banks probably don't have the hike to hike as much because you've lost some global momentum. And that's leading to pretty pronounced flattening of the curve. So let's see here. Jack McIntyre, who oversees more than 66 billion assets, quote unquote, the seeds of flatter yield curves globally have been planted. Central banks have started the process of withdrawing that stimulus. Some central banks have to remove it faster than others. He says, don't own, but it's open to hire. Okay. So in short, the one thing that can combat this flattening of the yield curve is further taming down the bond purchases and increasing the hike, which overall would be a detriment to companies who are relying mostly on their debt servicing. So this will come into fruition. It's like it's quite getting complicated now. Wow, yeah, it's gonna be interesting next year for sure. So
Yeah. So there have been talks that they might taper next month.
yeah,
I think slow tapering
right.
for starters, just to test how
The
things would
120
go.
billion. Hopefully that
Mhm,
makes a dent though, because if not,
mhm.
curves can still be flattened. And for all we know, it could slightly invert. And if it inverts, that's a crucial
Mm-hmm.
marker of a precursor for a recession coming close. So
Yeah. Mm-hmm. It's
uh-huh,
it's a dangerous situation,
right.
and the Fed has to deal with it. Um, we'll see. They've been, I think, in consensus to taper next month, right? November.
Yeah.
So there's talks about next year, but I think if they do it in November, we would have a better chance.
Right.
That's just my opinion, because November would be a good test, right?
Mhm.
uh, Before holiday season comes in.
Right. And in December
Yeah.
we have the crucial debt ceiling. So we'll see. So this is the weekly review, sentiment flows and industry performance. So the sentiment, American Association of Individual Investors, as of a couple of days ago, people are still bullish at 40% compared to last week, a little bit lower, 7% lower from 47%. We're at 40%. A little bit increase in bearishness from 28% to 29%. Neutral gained almost 5% from 25 to 30%. So historically, we're still way higher, or not way higher, but 1% or 2% higher than historical being bullish, according to the AAII. The fear and greed index, we're currently at 72, which is labeled as greed compared to 69 a week ago. If you're going to look at the chart, there's a big chart spike towards greediness level in the past couple of weeks. The volatility index, it's up 16% in the past week to 17.53 points. In the past month, it's down 22%. So a little less volatile for the past month compared to September, which we have experienced a drop of almost 5%. Excuse me. Since the start of the year, volatility is still down 35%, but it's slowly creeping up. Fear and greed for cryptocurrency, we're still at greed level 70 compared to last week's 75. And for this week, the performance outperforming as consumer cyclical, which are the companies that we just discussed. McDonald's, and those companies that can raise their prices have clearly been rewarded by Wall Street. And communication services, which are Facebook and Google, as we may have already known, Facebook has been encountering several backlashes because of its policies, which have been a drag. Energy, interestingly, despite oil climbing high, is down negative 0.6%. So not everything is directly proportional. For the past month, technology is the best performer, returning almost 8%, followed by oil, energy, 7.6%. Well, for the past month, everybody's up. Because last month, as we may recall, last month was a down month. So slowly, everybody else is going up at least. For the past year, number one performer, energy, 44%,
Mm-hmm.
followed by tech. Well, not tech, but communication services, which are Google and Facebook, financials, the banks, and real estate. So cash track, this is from Barron's. Mo money, he says. Cash came back to equity funds last week, shifting the last month's average weekly change from an outflow to a 1.5 billion inflow in stocks. Money markets, people took out money from money markets and sank to 1.4 billion. So people pulling some cash from money market, putting it back to stocks last week as of October 23. So this is the flow information from Bank of America. This was published just a couple of days ago. Value trade running out of steam. Financials and energy flows are negative for the past week. So if you can see the yellow line, it has dropped. So financials, energy receiving much less love from investors. So
That should change.
Mhm. So October 28th, this is yesterday, weekly flows. So look at this. Interesting. So Barron's indicated a back of equity flow towards stocks, 1.5 billion. This is as of October 23, right? 5 days later, October 28, Bank of America came out with their flow information, and looks like investors are putting more cash back into cash.
Mhm.
Largest inflow since April 20. And then 28 billion to equities, 8.7 billion to bonds. So there's kind of a push and pull. Last week, more into stocks. This week, more into cash. So that's quite an interesting play.
And I think that would uh, the investors will have more uh, conviction once the Fed,
Right.
you know, did, starts tapering. Once we know where the Fed is headed, then we will know what to do.
Yeah, and this is another chart from Bank of America. So they're just indicating here that the central bank liquidity is tied closely to the big tech. So it's like tied at the hip, as he said. Apple,
Mhm.
Amazon, Facebook, Google, Microsoft, Netflix, Tesla have all climbed up as central bank liquidity have risen. So this is the chart, S&P 500 performance since the past week. Looks like Nasdaq. I think this is a no. This is an incorrect chart. Here we go. For the past week, oil. We included oil in this chart. Oil have risen 6%, followed by Nasdaq index, which is the tech companies, 5.4%. S&P 500, 4.5. The lagger is the Russell index, the small cap companies, up 1.7%. So since the past year, since this is 6 months ago, oil has risen 26%, followed by Nasdaq, S&P 500, and the small cap are flat. And since the start of the year, here we go, oil up 65%, the best performing commodity, I believe, or at least the ones that we monitored, compared to Nasdaq's 24%, S&P's 24%, and small caps 18%. So, you ready for our roll the clip segment, Huawei?
Yes, of course.
So we have a couple of clips from the same person. One being interviewed in CNBC, and one he's being interviewed in Bloomberg. So let's play the one in CNBC, Morgan Stanley CIO, saying inflation is here to stay, will be more persistent. 11,000 views as of October 25th. It was published October 25th. Let's play it.
Do you fall into that camp for hyperinflation?
Hyperinflation is a strong, hyperbole, gets people all worked up. Look, we're definitely in the inflation camp. I mean, as you remember, Joe, over a year ago, we were talking about inflation before it was fashionable, and we're now seeing it, right? The market's digested.
Stagflation?
The stagflation is another hyperbole people like to latch onto. Look, we're in a reflationary world after 20 plus years of disinflation. That's a different investment environment, okay? And so you need to have things that are levered to higher rates, higher inflation, like financials, like I just talked about a minute ago, like some of the commodity sectors, which have done well here. But doesn't mean you can't, you have to abandon growth stocks. You have to abandon stocks altogether. It just means you have to be much more attentive to valuation, which we're trying to do within our portfolio construction. So, the bottom line is we have inflation. It's here to stay. We think it's going to be more persistent. We're buyers of the inflation dip if we ever get one, which we think could come in the first quarter of next year as demand slows down and maybe supply catches up to where demand has been. And that's something to kind of think about. It's also going to be a much more volatile economic outcome than we've enjoyed for probably 20 years because of that inflationary impulse. Hyperinflation, that's not something we're propagating right now at all. It's more just that we're going from a disinflationary world to a more inflationary world that's more persistent, and that has implications for asset prices across the board.
Mike, do you ever think we'll have a secular bear market again? And if we were going to look for a reason why we might get into that period, you would think that multi-decade lows in interest rates, that the lows are probably in now, so that's headed up. Reflation after decades of no inflation, now that's headed up. Would you ever make that forecast that there's going to be a multi-year sort of not a great time to be in the stock market? Is that now, or we're never going to have a secular bear market again?
That's a great question, Joe. I'm glad you asked it. We do not think we're entering a secular bear market yet. Will we have another one? Of course. What's the timetable on that? I mean, your guess is as good as mine, but we try to do that, as part of our job. I would gather it's probably middle part of this decade, as this, this expansion runs out of gas. My guess is, it's going to be tougher, right? We're not going to have all the levers to pull. Monetary policy has kind of run its course, we think. And that's a very important observation, as you point out, meaning in the next downturn, can monetary authorities really do what they've done over the last 20 years if inflation under the surface is brewing? And the answer is probably no. The other thing you have to ask yourself is all the things that have been going on that have been driving disinflation, like outsourcing, globalization, technological development, has been a huge tailwind for profit margins. And so that's the other kind of collision course here. But that's not today, Joe. That's not our call. We think this is more of a cyclical pullback, probably not even a recession. It's more of like just, it's basically absorbing all the good news from the past year. We've done that, and now we have to go sideways, maybe down a little bit, not the end of the world. It becomes more of a stock picking environment as opposed to last year when all boats were sort of rising on the big tide.
And before we insert our opinions, we're going to play this clip by the same person, Morgan Stanley CIO, October 22nd, entitled Morgan Stanley's Wilson Pushes Back on Correction Call. It was viewed 8,000 times. Let's roll the clip.
Mike, you know how the pressure builds at this time of the year. You go into year end and people expect a year end price target for you for the following year. How difficult is it to deliver one of those right now, given everything you've just said?
Well, as we like to say, it's easier to forecast the future the further you go out than it is the near term. So 1 year is difficult. 7 years is the easiest period. But 1 year is easier than next month. So, we're going to do our usual process. I don't see a whole lot of changes, quite frankly, in what we've been talking about on a 12-month horizon basis, the risk reward. The index level is not particularly great. We see some great opportunities in individual stocks and in individual sectors. I mean, one thing that's going on and has been going on for a while is the bifurcation in valuation is still dramatic. You look at the valuation of the banks and energy, for example, versus, long duration growth stocks, it's never been wider. And there's a reason for that, right? We're in financial repression. And so we'll see if that continues. Once again, our job as strategists and analysts is to find the best risk reward opportunities. We think there's some good ones out there, and we think there's going to be some pretty bad ones next year.
Mike, we've worked through some of these issues together through much of this year. And from my perspective, you've really nailed the correction, the rolling correction we've seen from, say, the middle of March, the small caps and out from there. Where perhaps you've struggled is just what's happened at the index level. Mike, you've talked about that 10 to 20% correction at the index level. Can you help me through that? How one you've called beneath the surface of the index and the struggle perhaps for the index level correction that hasn't quite materialized?
I'm not sure what call you're talking about, John. So, look, the S&P 500, I think where we probably got ahead of ourselves is that, in the mid-cycle transition, the market does gravitate to high quality stocks. That's how we positioned ourselves. And the reality is that the S&P 500 is the highest quality index in the world. So we think that this has been, delayed here most recently. We got a 6% correction in September, big deal. It's not even worth talking about. We still think there is a larger correction in front of us, probably as we go into early next year at the index level, because that's the way the mid-cycle transition ends. It ends with a correction in the highest quality parts of the market. We'll see how it plays out. I'm not so focused on that at the moment. I'm more focused on the internals of the market, trying to make money within the market as opposed to the index.
Yeah, I want to be really clear here. This is not about being snarky or calling someone out. This is really, really hard right now, Mike, to get these calls and to see them develop. You talked about gaining some confidence that the correction could be bigger than 10%. That was a few weeks ago, Mike. I just want to understand the latest update to your thinking as things evolve right now on the screen, what you're learning through the price action.
Absolutely. And John, I was teasing back there. I mean, absolutely correct to call us out. It has not been a good view on the level of the S&P, and we own that. So look, I think that the fire and ice narrative that we've laid out, the fire scenario has played out. While Greg is right, the Fed's not going to do anything crazy. They are tightening. They are tapering asset purchases, and for financial assets, that's going to have a headwind for valuations. That's the fire outcome we always get at this stage of a recovery. Usually results in about a 20% reduction in PEs. Okay, now earnings offset some of that, and you usually get about a 10% correction. Check the box on that. We got a 6% correction, 7% in the NASDAQ. I think we checked the box on that, and we're making progress on the fire scenario. The ICE scenario is really that we think there's going to be a greater slowdown in growth next year from an earnings standpoint than what the consensus is modeling. That may take another 3 or 4 months to play out, because at this window, companies are going to get a pass on supply constraints, and we have the seasonal strength that Kate talked about in the near term. But I have not lost, any confidence in the idea that the numbers got to come down sometime between now and January. So that's still out there, the ICE part of that scenario, and we think it's just going to take a little longer to play out.
Wow. What do you think, Huawei?
Well, I tend to agree with possible mid-cycle correction early next year, and that's a normal thing to happen.
Right.
Yeah, with all the help from the Fed Reserve, we had unprecedented opportunity during the pandemic for growth. So it's just normal to expect some form of mid-cycle correction.
Right. But my thoughts on this is like the CIO, he's a really intellectual man. But the thing is, I think he's trying to call what's going to happen in the market, whereas nobody knows what's going to happen in the stock market, what's near term and long term. As he said, it's easier to predict what's going to happen 5 to 7 years from now, which when he was asked about having a secular bear market, for those listeners who are not aware, a secular bear market is a long period of time where stocks are dropping or just consistently going down.
Yeah,
so
10 or 20 years.
Yeah, so he's been asked about that, and he said frankly that he doesn't see that in the near term, maybe the mid part of this decade, which is around 2025. But at this point in time, he's looking at cyclical pullback, which, because combining it with his interview with Bloomberg, which he was discussing the fire and ice play, fire meaning that the Fed is tapering and it's going to be a headwind for valuations, which he corrected himself. It's going to be resulting in a 20% reduction in PEs. So it's not the index itself won't drop by 20%, but the PE of the index, the price to earnings will drop 20%, meaning prices would be lower over the near term, despite the earnings being justified, at least climbing or growing steadily. And another part that he discusses the ICE scenario, which is where the greater earnings growth there would be a slowdown in the there'll be a greater slowdown in earnings growth in the coming 3 or 4 months, which we are already actually experiencing as a result in the past couple of weeks when big tech started reporting. So when these play out, he's forecasting now that we might have a correction in the indexes early next year, which he also said that he's going to be a buyer of this inflation dip. So this is something to watch out for, because this guy handles billions and billions of dollars, and he's not coming from a small tiny bank in one corner of the world. He's the chief investment officer of Morgan Stanley. So
And I think investors are listening. Just looking at your graph from Bank of America,
right.
the reversal from equity to cash just tells you that people are listening. Companies are listening.
Right. And it's funny how the interviewer there in Bloomberg has called him out regarding his change of view, looking at the 10 or 20% drop in the stock market, which he admitted to. They don't get like 100% correct. If so, they're already they may already be richer than Elon Musk. So I think this is the last.
Well, I think, Mark, before you go into the other topic, I think what we know. I think the experts have pretty much determined that we're not going to go into a stagflation, that we're going to go into inflation. At least we know that.
Yeah, higher costs leading to lower profits, as Amazon have pointed it out. 0 profits to 3 billion. Wall Street expecting 7.7 billion. I think yeah, that's true. Inflation is here to stay at this point in time.
Exactly.
So now we're gonna play a clip. This will be a last clip. Our next clips will be played on our next episode. Hopefully, this is about the Philippine economy, but we're gonna tackle this on a next week episode. But last clip of the week from CNBC interview happened 4 days ago. 52,000 views, entitled Tom Lee. Tom Lee, Fundstrat Tom Lee sees oil going even higher after already hitting 2014 highs. Let's play.
The facet of the argument for the energy trade is that WTI has a capacity to go higher, that there's no demand destruction at higher prices. In your notes that I got, you say 252 is the magic number in terms of when energy could have a deleterious effect on the economy. Why that number? It seems like a very precise level for crude.
Yeah, Melissa, it's a rough number, but one thing we have to remember is oil really took the economy or pushed into recession in 2008 at $33 oil. In the last 14 years, the US economy is less energy intensive, and we've had general price inflation. So for oil intensity to hit the economy the way it did in 08, WTI would need to get to $252, and it's at $80 today. So there's a lot of room for oil to ascend from here without damaging the economy.
Tom, when you look at the sector and the subsectors in the oil space, do I buy it as a point? Because when I look at an ExxonMobil, a large integrated player, the stock is up over 50%. When I look at the E&P space, EOG is up 90%. Refiners are doing less than that. Do you get into the granularity of that, or are you just thinking about the commodity as a whole?
Yeah, Steve, that's a great question. As many of you, the viewers would know, oil has risen faster than energy stocks. So there's still a really substantial catch-up trade for energy equities to catch up to oil. And we think there's still a lot of price support for oil to ascend higher from here. It looks like energy is one of these dartboard sectors right now where almost anything you do will actually be a profitable trade. But I think the best sort of investment strategy is to really bet on a supply response, which means capital spending should start to accelerate, and that should take people to the oil field services sector. And I think one of the challenges people have today is that they think oil is irrelevant because it's ESG or it's a melting ice cube. But you have to remember, if capital spending is going to rise for 5 years into energy services, that's a secular growth trade. Growth managers who bought oil in the 90s are going to come back to this. So this could really morph into a GARP sector. And I think that's the second leg of sort of the acceleration of the group.
Hey, Tom, it's Tim, and that leads me to my second question about really going back to those trades that we saw, and they include country trades. So oil for Russia is still, unfortunately for their economy, their only ticket. Break out of the RSX ETF, break out even in South Africa, even where you have some currency issues. Your thought on playing countries that have exposure to this trade?
Yeah, there's a great statistic from the CIA about energy exporters. Roughly 40% of global GDP or countries make their money from exporting oil. So the rise in oil is a huge reflationary trade for a lot of emerging market and sort of non-developed world countries. So if you're sort of thinking EM, that makes a lot of sense. And if you're thinking regions, like you said, whether it's Latin America or Russia or Africa, they're going to benefit. But technology, sort of, if you want to have a technology bent to your trade, it really should be U.S. oil services companies.
Yep. Hey, Tom, it's BK. So that's kind of interesting. I mean, one of the reasons that is cited for the run up in oil here is we haven't had that investment in energy services. You've got companies like an ExxonMobil paying out a dividend, looking a lot like a tobacco stock because of ESG. I guess the question is can they ramp up that quickly? And what should we look for that ramp up? Because it would seem to me then the energy service stocks could get ahead of themselves without the big companies kind of coming back in.
Brian, there's so many great points you brought up, because number one, tobacco was a great analog in the 90s because people thought people would stop smoking with these huge state settlements. And as you know, tobacco stocks were great equities really in that intervening period. Today, energy stocks are trading at 3-4 times free cash flow. But more importantly, I think that if you look at the fact that the world is becoming more digital and things like cryptocurrencies and digital assets are becoming sort of central to how we do centralized finance or decentralized finance, that means energy intensity is actually going up. And so there's a thesis around owning energy equities because it's a low cost way to actually power things like the Bitcoin network.
Tom, good to see you. Thank you.
Thank you.
Tom Lee.
Looks like oil is about to stay or slowly increase at this point.
I like how you ended that with the Bitcoin network.
Bitcoin network.
Well, Bitcoin needs that energy too.
Mm-hmm. Oh yeah, that's true. Because they consume a lot of power.
Yeah, a lot of power
to generate coins, mining operations. So what do you think, on the oil?
Well, bet on oil because oil and energy will probably surge, right?
Right.
Stockpiles are low. The drilling sector is cautious. They've been harmed. Their profits have been harmed early. During the pandemic, and a lot of this ESG play somewhat affected the energy market. But look at the results. Energy is the highest performing of all the sectors in the stock market.
Yes,
at
sir.
100% right now, more than 100%. And we're still gonna see a surge because winter is coming. There's gonna be more demand. There's still a lot of goods that need to be imported globally, and that needs that fuel.
Right. That's a really good point.
Yeah. And again, utilities, right? We still need utilities. We don't have the infrastructure for renewables that would sustain the demand. There's still that gap. So if we're talking about renewables, we're not there yet. The infrastructure is not there yet. So guess what? We'll have to depend on fossil fuel.
Yep. And like what Tom Lee just said, it's gonna be a secular run-up in oil,
Yes.
secular growth trade on energy and oil. This what will carry the next leg up in the recovering economy, or at least booming economy at this point in time, hopefully, in the
We
coming
need
year.
it. Yeah, we need it to grow our economy. Exactly.
All right. Well, before we end our show, Wowie, do you have any quote for the week for our listeners?
Yes. So this is from Ken Honda, the happiest money guru of all. He said, "Those who spend on experiences that align with their values seem to be the happiest overall."
Oh, I see. Wow. Well, that makes sense. You gotta spend money on what you desire,
On what you value.
what you value. Well, that kind of like strengthens it, right? The more you do it, the better it goes. Like you're trying to reward yourself.
Yeah, be honest to yourself. What do you want?
Well, Wowie, thank you so much for coming on. It's been a long episode. It's been 2 hours and some. So this is so far in our 22 episodes, this is the longest. But yeah, I enjoyed doing this discussion with you, Wowie, especially during
Yeah.
the earnings season, because not just the earnings, but we also are seeing some slowdowns in parts of the economy, and we cannot really like. I myself cannot see this just by myself. It brings out more understanding whenever we discuss such information.
Exactly. There's a lot to discuss.
Yeah. Well, next week we're gonna tackle some information about the Philippine economy, how it's recovering, and probably tackle some General Motors and Ford as well. So, listeners, I guess that does it for this week's episode. I hope you guys enjoy it. Please subscribe and support us. We don't earn from this. We're just doing this from hobby, because of hobby.
Mhm.
If you have any questions, send your questions at email markywowishow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. Again, this is Mark Yu signing out.
And Wawi Santos, thank you for our supporters.
Bye.
Bye.